thank you very much for coming from afar to Israel, and especially big thank you to Boris and Ali, who is the first time in Israel. So thank you very much for this. Amanda, why did you start with a quick intro?
Sure. So thank you. Firstly, just the hugest thank you to Vintage. It feels surreal to be here, and just this has been the most incredible day. So thank you. It is such an honor to be, London last year, but Israel is where it's at, and it really feels like that right now. So I'm just so excited to be back here. I used to come here very often and haven't been in a few years, and I just love seeing the ecosystem you're building. Just very quickly, I'm Amanda. I'm a GP at Founder Collective. We are a very focused pre-seed seed fund out of Boston and New York. We're all founders and operators, and really we look to be the most aligned fund for founders at the seed stage. We've all kind of, hired the wrong people, fired the wrong people, messed up, gone on the wrong journey, and we really look for a way to be empathetic with our founders, and we believe that size is really strategy. So, over 5 funds, we've kept the fund sub 100 million. I know that earlier Abe spoke to that. We're very specific about that. We think that's where the returns are. Generalist investors, been very fortunate to be involved in some incredible companies, including some incredible Israeli companies that we're very proud of. So just excited to be here and share with everyone.
Thank you. My name is Boris Wirtz, founding partner of Version 1 Ventures, early stage, pre-seed, seed, generalist fund as well. Just raised our latest fund, Fund 5. Thank you, Vintage, for coming in. $75 million early stage fund plus a $30 million opportunity fund. Very simple investment thesis, investing in mission-driven founders that are building early in big waves. So special founders that really truly care about solving a specific problem for the long term, and doing that before the category even has a name, ideally. So it was like vertical SaaS back in 2012 to 14. It was crypto from 16 on. Right now we're spending a lot of time in vertical robotics and India.
Hi guys, my name's Ali. Thank you so much for having me. This has been a great first trip. I manage a fund called Crossbeam. We're a $70 million seed fund. I co-manage it with another gentleman named Michael Ovitz. So the two of us usually invest in stuff that has kind of touched things that we've done in our past. Before this, I ran a credit fund and a special situations fund. In that business, we were the biggest owner of YouTube videos in the world. We turned perishable produce into an asset class. We funded something like 20% of all the fruits and vegetables that came in the United States. We've bought accounting firms, wealth management firms, insurance companies. So usually, and Michael's background is largely in entertainment consumer. So we're usually backing companies where there's something about the business and something about our experience that we could have some sort of influence.
Amazing, thank you. Ali, let's maybe start with you about what is the biggest challenge that you face today as a seed investor, and how do you navigate it?
I think the biggest challenge is we have no idea what the hell's going on. The problem with this market is, and then I think we've all kind of shared this feeling, is it's moved very, very fast. And you go out, you raise a fund, you tell the story about all the things that you're going to do, and then you close the fund, and the next thing you know, the seed investing landscape has totally changed. One of the things that probably many of you have felt, and we certainly feel, is there's never been more interesting companies at worse valuations. And so you're sort of left with this weird dynamic where the market's moving really fast. You can't not be in the market. I mean, this is probably one of the most interesting vintages ever. And so you have to kind of change the way you invest compared to what you were doing in the last tech cycle. The last tech cycle was sort of the cloud application cycle, where by the end, it was a bunch of repeat founders who were really easy to diligence because they'd already all started companies before, taking one more sliver of the cloud market. And the question was not a lot of technical risk, but a lot of TAM and product market fit risk. Now, it's a bunch of 19-year-olds who are impossible to diligence because they've never done anything before, but they're geniuses or whatever. And they're building companies with the most obvious product market fit in the world. It's hey, do you want to find a new element on the periodic table? Yeah, it's pretty cool. But huge technical risk. And then you have to rethink, with valuations, you probably have to hit high valuations. So then you have to be investing in companies with a big enough TAM to support it. So it's just a different vintage than, no pun intended, a different vintage than we thought it was going to be going into it, and we had to be malleable and flexible.
Yeah, just to build on that, I think when I think about the internet and the impact on building companies anywhere, right, it was a very decentralizing function. Suddenly it was possible, you didn't have to have boots on the ground in the valley to build a huge enterprise company. You could literally do it from everywhere. AI is a centralizing technology right now. Everything is happening around a very small pool of talent in one location, San Francisco, and that obviously is a real challenge for anyone who is building or investing in companies outside of kind of that specific circle. Now, I think there's still lots of other opportunities outside of AI, and that's what we are focused on. But I think that's one of the biggest challenges right now, that we suddenly have a very centralizing technology around one specific location in a few companies.
I'll actually disagree with that and say I think that's our opportunity right now, because I think everyone is so hyper-focused and there's so much FOMO right now, like SF and huge rounds. And I think it's quite a privilege as a seed investor to kind of look at other places where people aren't necessarily looking. So I'd say, it's one of the toughest markets. We've been through a few cycles now, and I think it's an incredibly tough market. There's a lot of FOMO. I think we also like to say as a fund, capital has no insights, but that's not the sentiment right now. People are like, well, if I raise enough money, I'll figure it out. And we really believe in building super capital efficient businesses. So I think it's tough now convincing founders not to take massive checks when they're super early and still kind of meandering through the desert, and to say figure out what you're doing. The money's still going to be there a few rounds later, and slow down. So I'd say the hardest thing right now is actually investors slowing down, and then founders slowing down from just raising the capital that's being thrown at them.
And you mentioned that one of the tactics for you to invest wisely is maybe to go to places where it's not SF, it's not the hot regions. But I'm curious, how today at seed is quite competitive. It can be from local seeds fund, multi-stage fund, solo GPs, which we have many of those recently. So I'm curious how in this still competitive market, you are able to find good deals and win them and so on. And maybe Boris, would be interesting to get your thoughts on this.
I think it really starts to understand where your swim lane is, right? And we continuously think about that, as much what do you have to adapt in an ever-changing market? What do you keep constant? And for us, I would say kind of thinking about these overlooked founders, overlooked opportunities, and looking for them. That is still possible. You just have to look harder than before. We are rarely in a competition with a very large multi-platform, multi-stage fund. That's just not our game. We're not momentum investors that chasing kind of the latest deal. But to be honest, I think every investor in such a fast-moving market thinks about how do you position yourself? Do you have to adjust? I think we came to the conclusion that when we look back at our 13 years of investing, every time we thought we had to adjust because some market movement, ultimately it didn't really work out. Every time we stuck to kind of our first principle approach of what we do best, right, we ultimately succeeded. So I think that fear and paranoia you always have in such a market. So just super important to kind of figure out what your swim lane is and just sticking to it.
So I have a slightly different version. So I think when we started doing investing, we were obsessed with being contrarian. And I think it's important to have a healthy relationship with being contrarian versus consensus. I think actually in this market, there are deals that you can do that are consensus because there's just been so much center of gravity built around certain markets, certain companies, certain teams. It turns out that's actually worked. And so I think for us, some of it is deciding what are the consensus markets where we have a right to win. And then trying to play offense in those markets. And so for us, it's just certain verticals where we know the customer base, we know kind of the players, and I think we just have decided that if it's going to be a consensus company, and the seed round is going to be we did. Please don't fire us, by the way, or redeem or anything. But we did a seed round 70 pre, and we were what are we doing? But it was just they were building an AI-enabled bank, and we knew enough about the mortgage space, and the founder was incredible. He had taken his last company public, and so I think for us it was just sort of rethinking what our relationship with contrarian consensus is going to be, and when we're going to be in something consensus, the TAM better be amazing, and if we're going to be in something contrarian, then I do think we have to just stick to our knitting.
Maybe it's a good segue to the next question of how to deal, as seed stage investors, how do you deal with expensive deals? Because today, obviously, if it's an AI, pure AI deal, the price might be very expensive. In Israel and also abroad, if it's a second-timer founder, it's also very expensive. So I'm curious, Emena, what is your strategy around those deals? Whether are you participating in them, chasing them, or maybe you don't? Curious to get your thoughts.
So firstly, I think, like Boris said, we try to stay consistent, and like Ali said, but we also break rules. And I think you've really got to figure out when you break the rules and when you don't on pricing. I think we've got a few ways that we think about, pricing and how we really do see over time that entry price matters. I know that there are many investors who disagree with that and feel like, you just got to be in the right companies, but we do see that if you can really stay disciplined, there's more opportunities for founders to build the types of companies they want to. And we think it's sometimes an impediment to founders when they raise kind of crazy rounds at crazy prices. So, firstly, I think network is net worth, and sometimes really just building that relationship with the founder and getting to them early enough where you can say, like, just do a small pre-seed, figure stuff out. So getting in early is, I think, the easiest way. I think looking in less obvious geographies, Boris does an amazing job there, I know. And, I think we're in Israel right now, and we're definitely, not that Israel is any less expensive than anywhere else, but recently made an incredible investment in South Africa. We've made investments in India. So I think really looking just beyond SF is a way to, we see New York, being based in New York and Boston as a strategic advantage, and a way to kind of, we've got to work to give founders our money, and we've got to convince them to kind of take it at the right price, and that's part of our job. And then I think really not getting caught up entirely in the hype. And we always say, if it's a theme, we're too late. And like if you look in 2015, when OpenAI and Ethereum were started, what was the big theme of the day? It was like VR. And so I think if it's a theme, we're too late and you're paying for it. And then I think Shield AI, we invested in it in 2016 when defense tech was not a hot theme, but we found amazing founders and convinced them to take some money early. We took a bet on them. The technology was not developed. So I think kind of factoring in risk and stage really helps in terms of figuring out how to get in early before it's obvious. Because I think once it's obvious, you're paying up.
Yeah. And Ali, I think you had a mental model for like how to sort of underwrite an AI company into high valuation, right? No, because I think we spoke about it one time, where you have a certain framework to understand when does it make sense to invest in a high valuation.
I mean, I think a lot of the times it's just TAM, as I mentioned, and ultimately you're just trying to make sure that enough of your fund is in a company and the money multiple is high enough where what people mean by ownership really is they just mean will this move the needle for my fund? Also sometimes, and this is a couple of the rounds that we've done that we've talked about, you do have to kind of think about the round as a seed round and a Series A round, and then thinking about what risks am I normally taking at the seed, and then what risks am I normally taking at the Series A, and can I convince myself that basically I'm just buying 2 rounds in a row because there's less risks than normal. And so we did a deal recently, and it was like us and a couple other hotshot VC firms, which usually is a reason not to do the deal, but in this case we thought they both made sense. The founder had sold his last company for 9 figures. We knew him really well. So unlike a normal seed round, you really had mitigated a lot of the founder market risk. It was in a market where we're a customer of a similar product, the old school version of the product he was trying to build. We would be a customer at the prior fund that I had started. I knew 12 customers that he should immediately have. I introduced him to Fortress and Canyon Capital, all these firms that he immediately wanted to become the customer. So then you had de-risked product market fit. So we got to the point where we said we're taking more, the seed risk is not really seed risk anymore. A lot of the things that you're really not sure about at the seed round, you've kind of convinced yourself of. So we were really just sort of buying the seed and the Series A at the same time. And then that meant that we just had to size up our check, and knowing that we weren't going to reserve as much for follow-on rounds. And that was an example of one of the deals that we could do. So there are moments, and those are some of the moments. I will say, though, on the other side, we've only done, I think, 3 deals this year so far, which is really rare. I mean, usually we're doing 10 to 12 a year. So it has been harder to do seed rounds than normal. And then the other thing that we keep telling ourselves is, if you think of, there's 2 kind of counter arguments. The first one is, if you think about any wave, the cloud wave, mobile wave, internet wave, whatever, you didn't have to be the first to make the most money. I would argue that the people who invested and deployed capital kind of at the later stage, the cloud wave, actually made more money than the very, very first movers. And so trying to create that humility, the counter argument to that is all the players who are investing today also saw that whole movie already. And so in the same way that we were all kind of starting our careers in venture capital and didn't know the next scene yet, we kind of know the next scene a little bit better, which is also why I think you see this acceleration and people are just pulling these companies a few rounds forward because they already feel like they know where it's going.
Boris, I don't know if you have any thoughts about expensive.
Yeah, no, I think in general, if you do it for the right reason, meaning you have conviction that this is a special founder, this is a huge market, you had time to really think that through, getting to know the founder, then yeah, you obviously can buy into that. The contrary is like a YC round where you have 24 hours to decide on a $40 million capped or even uncapped note, right? And everybody's piling in. Like that just doesn't make sense, right? So I think you just have to do the work, and sometimes you just don't get the chance to do the work because the round is moving so quickly and people are not even interested, founders are not interested in engaging properly with investors, and that's okay. That's just not your type of founder and not your type of opportunity. But if you get the chance to get to know the founder and develop conviction, then yeah, you should pay up.
Maybe one last deep question is like whether investing in AI today as a more or less $100 million fund, does it affect in any way the way that you construct your portfolio? You know, like check size, how many bets you're doing, stages, and so on. I think maybe, Amanda, you have some strategy around it.
We actually do have a strategy around here. We write two sizes of checks. We can either lead around or we write what we call an angel check, which is a smaller check. And I think we've seen when the market's really fast, really heated, we lean more into our angel strategy, which really helps you kind of like spread the risk, because I think there are going to be more losers and a few big winners. And I think that has really helped us versus like, it's really hard to double down right now and get to know the founder and spend enough time. And also when we lead, we sit on, you know, we take a board seat. I really want to, you know, I'm taking on a massive amount of just commitment when I do that. So I think for us, we've really leaned into that. And, you know, I think with AI, I think the other just massive risk is there are companies that are becoming obsolete with one, you know, Raya just gave an amazing presentation, but they're changing the model every day. And every day there's a company that you thought was amazing that is irrelevant the next day. So I think there's just a lot of risk in the market right now that if we think we know, we really don't know. I think ultimately, like the biggest with AI is also from what Raya was saying, but is like founders who can learn incredibly fast, because I think very few founders we invest in today are going to build the companies they tell us they're building. But does that founder, you know, were they a commander during the war, and can they pivot and really kind of navigate the situation? So I think looking for those types of founders when we invest in AI is more important than like the concept that's necessarily presented to us.
So we have been thinking about adjusting our portfolio construction. Came to the conclusion in the end we're going to keep it right now. So our portfolio construction right now is like 25 to 30 portfolio companies, 10 to 15% ownership in general, and every single portfolio company needs to have kind of the potential to pay back the fund 1x at least. Now, if I would raise a AI-only fund today, probably I would kind of model it with 60 to 70 portfolio companies, smaller checks, smaller ownership, and hope that kind of out of these 60 to 70, some will hit really, really, really big. I find it hard to kind of combine these very different approaches in one fund. But you know, I definitely like kind of the thought about an angel check strategy to address the AI market versus kind of the more traditional market.
So I think like the shift that we've seen in the last few years is one of the reasons. You know, everyone likes to talk trash about venture capital and like, are the returns actually that good or whatever. I think venture capital is like the most durable asset class ever. Like if you find a good opportunity in credit, immediately it gets arbed away because everybody does the same thing. If you find a good opportunity in private equity, whatever asset, hedge funds, like there's a reason hedge fund managers never tell you their best ideas, and VCs go on panels and tell you their best ideas, because it's all about like the new one. And I think that this market has proven that like the VC firms that are going to do well are the ones not that go out and say, well, we've done the same thing for 15 years and you know we're going to keep doing it. Just like founders, like if the market changes for a founder, you want to back a good founder, and the founder pivots and does something new or realizes they need to address a new type of market. Managers are the exact same way, and what we're all trying to do is say, we all used to run VC funds in one market, we're now in a different market, and so we have to rethink, like, how do we invest? What is our ownership strategy? What types of founders do we back? How do we source those companies? And so I think for us, like, the whole point is, it's not where you land, it's that you're, like, willing to be malleable as the vintage itself changes.
All right. In 2-3 words for each, what is the most exciting opportunity right now at Seed?
Israel. Simple.
For us, it's India. I've been spending a lot of time in India in the last 3 years, and love love India and the opportunity. In
Dude,
seed right
audience, man.
now. You know, you have to be contrarian.
All right. Thank you very, very much. It was great having you.